Hello and welcome to Bazaar Morning Call. We're starting a fresh new week with a full team, with the full Bazaar team in the studio. Sonia is back from her holiday. Sonia, good morning. Nigel, good morning.
Morning.
How does it feel to be back?
So, the thing is, morning, Nigel. The thing is, every time I go on holiday, the market rallies big time. So I come back and the market is at a new high.
I see the suggestion. More holidays.
Maybe I need to take a little more break.
Come back wearing a bit of a reddish.
Well, I don't know. But I mean, it was great. It was good. And it was good to see that the market as well is in super shape. Of course, Friday was not that great, but let's see.
Absolutely. But, Friday's US session has been pretty good. And that's actually amazing price action is what we saw. Let me just quickly tell you what happens. The US markets fared well despite strong jobs data, right? Yields were lower, dollar was unchanged. So hot jobs data means there is more pressure on the Fed to do more. Market pricing should have been higher. It was not, it was lower. And that is what is so amazing. And we'll talk more about this. SGX Nifty is indicating about just under a 0.25% higher start by about 40 odd points or so. Sonia, hi.
Hi, morning. So, the thing is, of course, you guys have tracked the markets all of last week, but there are a couple of things that you need to watch out for this week as well. I think the market will closely watch for the RBI policy that comes out on the 7th. And in that sense, there's an expectation that the rate hikes, there have been 3 consecutive rate hikes, they'll be moderate this time around. A 35 basis points rate hike is what is expected, especially after inflation cooled off. It fell below 7% in the month of October. So that's one thing to watch out for. Of course, the jobs data, Prashant, you'll talk about that in greater detail and the impact that that would have on our own markets, but it was indeed very strong. And the payrolls rose, the unemployment rate is steady. But put together, the big question that I'm asking is, after a bit of a pause on Friday, will the Nifty look to achieve that 19,000 mark this week? Now, FIs and DIs both bought in the cash markets, and Brent crude has also been under control, just that it rose a little bit in the last 24 to 48 hours, but largely below that $88 a barrel mark. So that's the big question, right? I mean, it's been an uptrending market. It's been so strong. The dips are getting bought if there was a dip. And perhaps that 19,000 level is something that the market could eye this week.
It could come, Sonia. And, the point is, it's looking globally as well. Just look at the price action. So jobs numbers out of the US for the 7th straight month were much higher than expectations. Markets reacted. I mean, stocks fell, yields were higher, dollar was higher. But what happened at the end, the close is what really matters, right? Markets reversed all of the hawkish reaction to the hot jobs data. And this is what is so amazing. So a couple of points. The yields, the front end of the yield curve, the 2-year yields went up 17 basis points because the jobs data was hot. But it closed up only 6 basis points. The Fed's market pricing of where the Fed rate will peak out, this is in June next year, it shot up 15 basis points immediately as a reaction to the hot jobs data to 5%. It ended back at 4.9%. You look at the equity market, the S&P 500, it fell 1%, and then recovered to ending absolutely flat, 0.12%, nothing, absolutely flat. So the main takeaway, when data goes one way and price action does not follow, when price action goes another, the main takeaway is do not fight the tape, do not fight the market, do not fight the screen. The screen is telling you one thing. I mean, you follow that till it tells you another. So that's the main takeaway. To add to that, the Fed is in a quiet blackout period all the way till the FOMC meeting, which is now, a week away, practically a week away. That's what's interesting. So markets could be in a bit of a holding pattern all the way till the FOMC. By the way, right before the FOMC meeting, you have this US CPI data, which is on the 13th. 13th CPI, and then 14th, you've got the FOMC right after the CPI number. So, and you don't have any Fed speakers in between, right? So it perhaps is possible that we're in a bit of a holding pattern all the way till then. As I said, there are warning signs. I mean, you can look at, for example, things like the WIX. WIX is now inching closer. The CBOE WIX is inching closer to 19. It's at the same levels it was in April of this year, and it's around coming to those levels where there is a bounce which starts. But the point is, you let prices tell you that. You follow prices and don't try and preempt, especially if you're trading. Here in India, I mean, the Nifty closed lower after 8 straight sessions of positive closes. So that is important. Friday's high, I mean, if you expect the market to do well, I mean, the first level to take out is going to be 18,782, which is the immediate level to cross on the upside. I would say wait for the first hour, 1.5 hours, and then kind of take a call, because you're coming off market reaction in the US, which is positive, but data, I mean, the doubt will linger whether US will follow finally once again to the data with a one-day lag. It's happened before. On the way down, 18,639, 18,600 will be the near-term support. That's the range. I mean, if that goes, that brings into view the 20-day moving average, which is at about 18,388. I mean, that is some way off, some distance away, but that's the 20-day which comes into focus. Mid-caps and small caps did very well. I mean, they did well last Friday, which is they ended up 0.5%, 0.75%. And for the week, Friday to Friday, both those indices were up between 2 and 3%. So that part of the market, the rally in a way is broadening. Nifty was down 100, but mid caps and small caps did well. And that is very, very good news. So stock-specific action in the broader market perhaps is the way to go, and not just the 50 stock Nifty index, so as to speak. So, watch that as well. You want the rally to be broader. Even if the Nifty does not rally, the broader market rallies, I think, that'll be a positive tick mark in terms of how the day has been. Nigel, what are you watching?
Well, Powell's comments on Friday, I think that's what superseded any of these red hot jobs report or the likes. That's at least what the US market, the reaction told us. And I'll say that in Friday, our markets, it was the best session actually throughout the entire week. You'll see what you're talking about. The Nifty ended lower, right? 120 points odd. I say that because it felt like we were in an uptrending market. The breadth of the market was good. The mid-cap and the small-cap indices, they did a relative outperformance. And the outperformance was to the tune of close to 1.5% odd. So good going from the breadth of the market. Why did the Nifty end lower? Well, the cash market, there was no big worry out there. But in the F&O side of things, the FIs, they unwound some long positions big time. There was unwinding both on the Nifty futures and the Nifty bank futures. And they added some short positioning. I'm not worried about that. If you have some shorts in the system, in fact, it's good news because at some point of time, they could be forced to cover out. Short positions, well, they have gone up drastically. And the long positioning from around 75%, it's come down to around 66% odd. On the option side, the problem is that they're writing calls aggressively. So they wrote close to 1.7 lakh shares, and that's in the ratio of 10:1. The most active strikes for the 18,700 call, the 18,800 call as well, and the premiums as well should come up for you on the screen. On the downside, though, the 18,700 put did see a fair bit of writing. And on that one, the premium's around 100 rupees. So that's why the stop loss should be at around 18,600. Now, the Nifty bank, normally we don't see very big action out there on the option side. But in Friday's session, the 43,000 call saw massive open interest build up. Premiums around 350 rupees odd. That 43,500 odd mark is becoming a bit of a hurdle for the Nifty bank. So on the Nifty, resistance will be last week's high. We entered around 18,888 odd. So I'll say that's a bit of a resistance. But on the downside, 18,600 will be a support because of the writing we've seen at the 18,700 odd mark. SGX Nifty suggesting open in the green with a 30 to 40 point uptick. At some point of time, we'll get a bit of a dip. Buying the dip has worked, so don't change that. Look to buy on a dip today. What else, Sonia?
Okay, and of course, across the globe as well, right? There are things working in favor of equity markets, whether it's the China curbs, which have been eased, whether it's the dollar index, which is at the lowest level since the month of June. So let's see whether that date with 19,000 is something that the market can achieve today. The SGX Nifty is suggesting that the start will be definitely in the green. But we have a power-packed lineup. And first up, we have comments coming in from Sanjeev Prasad of Kotak Institutional Equities, who says that global equity markets seem excessively focused on just a single narrative in any market while largely ignoring other relevant variables. He says the one-trick variable are the reopening in China, growth in India, and the US Fed funds terminal rate. He also says we can only hope that these variables do not disappoint or some other negative narratives do not swamp the current narratives. In the Indian context, Sanjeev says the growth narrative looks rather weak.
Well, let's get you some money market views as well. This is B. Prasanna of ICICI Bank, who says that the dollar ended the last week softer as markets chose to look through the strong jobs data in the US and focused instead on the slower path of hikes by the FOMC. He says Asian currencies led by Chinese yuan advanced with China reopening news, but the rupee continued to underperform the dollar weakness owing to domestic oil buying and a pause in capital inflows. He says the MPC this week is expected to deliver a dovish hike and the dollar INR may trade in a range of between 81 to 82 to a dollar.
And on the bonds, you have a comment from B. Prasanna itself, who says that global yields continue to drift lower as Fed Chair Jerome Powell has reiterated that the pace of hikes would be slower going forward, ignoring the strong jobs data released. Domestically, he said bonds reacted positively amid supply concerns, and he expects the MPC to effect a dovish 35 basis points hike and the 10-year benchmark bond yield to trade with a positive bias within 7.1 to 7.30%.
Well, a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at Mahindra Financial Services, ICICI Bank, Sanghi Industries, Ultratech Cement, JK Cement, HAL, Iron Exchange, Hudson Agro, Dilip Belcon, and NTPC. We have all the stocks that will be reacting in all probability to positive news flow. While good Monday, actually, for the bulls, we're not expecting any of these stocks to open up in the red.
All right, at least not on the list, right? I'm sure there will be a few.
Yeah, sure.
The news flow is positive, but you never know.
Absolutely. Well, let's get in our sort of first guest on the show. Adrian Mowat needs no introduction, market veteran, emerging market equity strategist. Adrian, great to have you with us here. Thank you very much for your time. You know, when data goes one way and price action and markets another, what do you follow? They say price action. Are we at that juncture where you start to? I mean, this is the market pivoting in that sense. What's your sense? Maybe not the Fed, but the market.
Okay, so to try and unwrap what you're asking me there, the job data was better than expected, but I think what the market's been much more focused has been on the inflation data and how that data has been surprising positively. And so when you look forward, remember that we have futures markets for interest rates, and those futures markets were forecasting rates moving above 5%. And so that was already discounted in. And those don't seem to have been impacted by these the stronger than expected job numbers. I think the other thing is that the market knows that job numbers are lagging indicators. You know, employment lags economic growth, lags the slowdown. And I think what the market's also been a bit more encouraged by is that we're getting the sense that the Fed is thinking ahead and remembering that monetary policy has a lagged effect. So we've spent the second and the third quarter of this year with the most extraordinary headwind of inflation being above expectation, a Fed behind the curve, the most rapid increase in interest rates that I've ever experienced in my career. And that was a huge headwind for capital markets. And what capital markets are doing at the moment is they're breathing a sigh of relief. That headwind, which is the rapid rise in interest rates, now seems to have gone. It's not a tailwind. I don't believe in this sort of idea of this pivot that you're going to get a quick cut in interest rates. Typically, interest rates move to a level and will stay there for a period of time. But there's another incredibly important factor going on at the moment, and that's what's happening in China. So China is opening up. It's going to be disorderly. You might see some scenes like we saw in Hong Kong in the first quarter of this year. But again, the market's looking through it and saying, okay, this huge drag on the global economy, China's lockdowns, China's disruption to consumption, to consumer confidence, we could see a situation that as we leave 2023, that is behind us. And so we're seeing markets respond to that. Now, Chinese equities have rallied a lot, but we haven't even got to where we were in the middle of September. So I think we also need to think about putting that into context.
Adrian, good morning, and it's good to see you after a while. What about a market like India? Because we've been hitting record highs. Of course, there's a bit of a pause at the moment, but the momentum is so strong, and now is when there's a lot of money coming into the broader markets as well. Would you continue to pump money into a market like India? Do you think that this is just the start of the second leg of the bull run?
Okay, so I think the environment for equity markets is much better than it has been, and India will benefit from that. I think India is a place that will see quite a lot of asset allocation away from India as we go into year end. India has been a very significant outperformer year to date. If you look at EM funds, they're significantly underweight China. We're beginning to see the big investment banks upgrade their China exposure. You know, the real outperformance of EM in November has basically been driven by Chinese equity markets. And so I think international portfolio investors are going to feel very exposed for not having enough positions in China. And to some extent, India will probably suffer from that. But again, let's put this within a context of more benign global equity markets.
Hi, Adrian. Morning. Adrian, what about the currency space? The dollar index, it went around 115 odd. From emerging market perspective, like, we don't like that. But it's come back to around 105 odd. What's the outlook on that one?
I think the dollar peaked already, and that this expectation on interest rate differentials, which have been very much moving in favor of the dollar, the delta there has passed its best. We've had some interesting economic data out of Europe. European economy is still soft, but the economic data has been surprising on the upside. There's a real potential that you will see some change in Bank of Japan monetary policy. So for 2023, you want to be short dollar and you want to be long other currencies. And I think EM is set up for a very good year in 2023 with a weakening US dollar, with a China eventually exiting this crazy zero COVID policy, and still quite a favorable dynamic when it comes to things like commodities.
Adrian, I don't know if you have any strong views on oil. You did mention China, right? China was in a way out of the market, oil markets. And I was reading someone making the analogy that this is like a coiled spring in terms of demand for oil. It can come back very quickly and prices can snap back very, very fast. Is that a possibility? What's your sense?
Yes, so mobility in China has been very low. If you look at data for trucking, movements on highways, etc. So yes, China coming back into the market is going to be supportive for oil. Although I do think that the oil market's probably unlikely to move significantly beyond its current range. I would note that we've seen some very strong performance, some of the best performance on a monthly basis out of Australian commodity companies, basically on the back of China opening up. But as I look at the supply dynamics for oil, remember that you've got a consensus that the US goes into recession next year. So you've got a bit of a softening in demand from developed economies, and perhaps China coming in and bidding up a little bit of demand for oil. But I don't think energy is a place I want to be overweight in going into 2023. I think there are a lot more, much more interesting trades out there. I would highlight that we've got quite a lot of disinflation out there. Input prices year over year are down quite significantly. If you look at the cost of shipping goods, whether it's by air freight or by sea, those have come down significantly. And so I'm not so interested in things like energy plays. I'm interested in companies which might have input costs that are falling or rising less than their output costs and actually generate increased margins and positive earnings surprise against a backdrop where people are very negative on earnings.
All right, we will leave it at that. Thanks for your quick comment on the markets as well as on the overall picture. Adrian, thanks for joining us on the channel. Let's slip into a quick break, but there are plenty of stocks as we kickstart a brand new week. Don't go anywhere. We'll be back to Bazaar Morning Call. Well, this morning, the Asian markets are on fire, especially markets like Hong Kong, which are up about 3%. Nikkei as well in the green. Shanghai trading with handsome gains as well. So let's see. The SGX Nifty suggesting that things will be quite good for our own markets too. Abhishek is joining in first up. He's tracking a couple of stocks. There's M&M Financial and ICICI Bank. Abhishek, over to you.
To begin with M&M Finance, they have come out with their business update as of November. So over there, they have had a monthly disbursements of 4,500 crore, which is down about 14.3% on a month-on-month basis. And this percentage decline is perhaps the highest that you are seeing in last 7 quarters. However, collection efficiency have improved significantly to 96% in November versus 91% that they had in October. And gross NPA ratio has remained stable at around the 7% level for the month of November when compared to 7% that they had for October. However, compared to September, it's a bit of deterioration given the fact that for September, the gross NPA ratio was at 6.7%. Now, ICICI Bank had Analyst Day on Saturday for the sell-side analysts, wherein the bank has mentioned that they are focusing on micro markets. No direct or explicit target has been given in terms of the branches or to the employees for growth over there. So winning customer trust is of paramount importance is what they have mentioned, and the focus is on smoother customer journey, digitization and network expansion. So the focus continues to remain on SME and retail portfolio for growth over there. Back to you.
All right, good to see you back from your break, Abhishek, as well. Thanks for that. So that's financials in focus. Now, cement is the other sector which is in focus. Ultratech, JK Cements and Sanghi. Nigel, tell us more.
Well, let's start off with the big boy, then Ultratech Cement. You know, they've commissioned a clinker as well as a cement unit, and this was what they were guiding for as well. So 1.8 million ton unit is what they've commissioned at Maharashtra. Also, they've commissioned a 1.8 brownfield clinker-backed second grinding unit in Madhya Pradesh. So this is more or less on expected lines. They've moved to around 119.5 million tons. That's the total capacity. By the end of this year, that's in the next 3 months or so, you should see another 10 million tons getting commissioned. So that's what they've guided for, and that's likely to be the case. Opens up in the green. JK Cement, well, they'd already commissioned the grinding unit. Now they've commissioned the clinker unit. So that's, you know, something that you were waiting for, 2.6 million tons unit. And in the month of November itself, they had commissioned 2 grinding units of 2 million tons each. That's in UP as well as in Madhya Pradesh. The total capacity moves to around 19 million tons. So we're going to see a surge in cement demand. Well, they are well positioned to grab some market share. Moving to Sanghi Industries, and that'll be the most exciting. The other two commissioning was more or less par for the course. Sanghi Industries, well, the promoter entity has taken shares, 7 million shares at a price of around 68 rupees 25 paise. And the total money they'll be putting in is around 50 crores. Just doing a rough calculation, their holding will go up by close to around 0.8% or once the money comes in. The shareholding, well, they had close to 72% stake, but bulk of that was pledged. So keep that in mind. The debt is something that they've been struggling with. Around 1,310 crores is what it is. But expect the stock to open up the green. Promoters showing the faith and putting some money.
Okay, that's always a good thing, right? Yeah. Let's move on and talk to Vahishta about HAL and Iron Exchange. Vahishta, you're watching these stocks?
Yes, that's right, Sonia. I am looking at HAL. Let me start with that, which has received an income tax refund order of 427 crore rupees. And the said order was passed, allowing the research and development expenditure of approximately 600 crore as the capex. And the refund includes the interest of 177 crores. Going with the green here, moving on to Ion Exchange, which has been awarded a contract by the Indian Oil Corporation Limited. This is for the designing, engineering, manufacturing, supply, commissioning and the operationing and the maintenance. This is for a period of 5 years of zero liquid discharge plant at the Panipat refinery, and the contract value is at approximately 350 crores. The project is to be commissioned within a period of 16 months from the date of letter of acceptance. Back to you.
Okay, all right. Thanks a lot for that, Vahishta. Mangalam joins us as well to tell us about Hudson Agro. They had a board meeting to raise some money. Mangalam?
That's correct. So, you know, for Hudson Agro, we already knew that they were looking to raise about 400 crores in via rights issue, but now we have the modalities of the same as well. The outcome of the board meeting is out with us. 301 odd crores is what they're looking to raise. A little over 400 rupees is the rights issue price that they have. The entitlement ratio is close to around 1 right for around 30 shares that they own. The shares currently are trading upwards of 900 rupees, closer to 940 odd rupees. And if you, adjust for the rights issue price and take a normalized price, the adjusted price would be close to around 928. And that is something that the street will be looking at. The better part about this rights issue is the fact that, you know, it improves their balance sheet. They have a net debt, or they have a debt of over 1,500 odd crores. With the QIP that they did earlier and this rights issue, their net debt comes closer to zero as against close to around 1,500 crores that we have right now.
All right, Mangalam, thanks very much for that. Dilip Bilkon and NTPC, the next two we're going to talk about. Vivek is here with those two. Vivek, hi, morning.
Well, good morning. Yes, Dilip Bilkon on radar on the back of the fact that the company has gone ahead and signed a contract agreement with Gujarat Metro Rail Corporation. This is regarding construction of certain parameters as far as the Surat Metro Rail project is concerned. The total project cost for this particular project is around 702 crores. NTPC, a very interesting development. Now, newspaper reports are indicating that the company is looking to onboard a strategic investor as far as its green energy platform is concerned. The green energy platform is called NTPC Green Energy, and it houses all of the renewables, green hydrogen and storage operations that the company actually manages. So what is NTPC looking to do? It's looking to raise close to 2,000 to 3,000 crores via this particular transactions, and newspaper reports are indicating that pension funds, equity investors and big firms are the ones that are actually gone ahead and speaking to the company. Now, this is a stated ambition as far as NTPC is concerned. They've been wanting to do this particular value unlocking, and they're looking to complete this by the end of this fiscal year. We haven't independently verified these newspaper reports.
Okay, all right. Thanks a lot for that, Vivek. Well, let's do a quick recap then of all the top stocks we just covered for you. And as we told you earlier, all of them have positive news flow. Mahindra Financial Services, ICICI Bank, Sanghi Industries, Ultratech and JK Cement, HAL, Iron Exchange, Hatsun Agro, Dilip Bilcon and NTPC. No stocks with negative news flow.
Okay, but we'll also keep an eye out on Angel One because the data for the month of November has come out. Just a while back, actually, they updated it on the exchanges and the numbers are quite weak. In fact, the gross client acquisition is down for the third straight month. So perhaps that could be one of your red stocks today, considering there's some negative news flow there. But moving on, let's find out what's happening in the world of commodities. There's lots actually. China has eased COVID curbs. There's the OPEC Plus meeting. Manisha is here to tell us about how all of this has impacted crude overnight. Manisha.
Sonia, thank you for that. Well, I'm taking good news with both hands right now. I mean, as you mentioned, the dollar index is now trading below 105 sustainingly, and there is now a 92% probability, as the CME fund tools show, that the rate hike possibility is about 50 basis points. So markets clearly factoring that in. And as you mentioned, the China easing COVID restrictions, they've done some more dialing back over the weekend, and that clearly has been supportive. And, some of those slowing down fears also seem to be getting now balanced out. The U.S. non-farm payroll data is coming better than the market expectations. So the slowdown or the recession fears seem to be going away, and the markets are looking at strong demand coming in for commodities. So whether it's crude, which is trading nearly 1.5% on the higher side, or the metal prices, which have opened up multi-month highs yet again. You have copper now trading at a 4-month high, and a very strong run-up in the precious metal prices also. Gold is at a 5-month high, silver trading at a 7-month high. So everywhere that you look, there's a lot of green on the screen.
Okay, green is what we like. Manisha, thank you very much for that. So that's commodities info. 8:30, 30 minutes to go for the pre-open session. But let's get you some important opinion. The first G20 Sherpa meeting took place in Udaipur yesterday. And from the sidelines of the meeting, my colleague Parishit caught up with Sanjeev Sanyal, member of the Prime Minister's Economic Advisory Council, and began by asking him about the priorities for global economic growth to be placed before the G20. Listen in.
India's priority has got to be to maintain growth at a good level. We did go through a recovery from the COVID shock, but then again, as you know, the global economy is beginning to again lose momentum. Some of it is, of course, due to sucking out some of the stimulus that we had to provide during the COVID recovery. But there are many other sources of turbulence, whether it's energy prices or, supply chains and so on. And I think the G20 has got to apply its mind to make sure that the global commons are kept in shape and kept open. And so I think this is an important part of the discussion over the next 1 year under the Indian presidency, basically maintaining global commons in a shape where economic growth can be sustainably sort of driven.
We believe that the strong capital allocation push would continue with Budget 2023. What are some of the priority areas the budget can focus on?
Well, I mean, the fact is that we have committed to capital spending as a way of maintaining growth. You can't suddenly switch that off. So that has to be maintained over time. But at the same time, let me say that now that we are out of the immediate crisis period, there has also got to be some mind space has to be applied on sustainability and macro stability. Even at the height of the economic crisis, you would have noticed that we remained, from a macroeconomic perspective, quite conservative. I think that conservatism stood us in good stead. So, we are generating something in the range of 7% GDP growth rate. Next year, we expect to be somewhere in the 6.5% to 7% growth rate again. It's still the world's fastest rate. That doesn't mean that our economic supply side cannot generate higher rates of growth. It can. I would posit that we can grow at as much as 9% if we really push ourselves, but that would mean that we would sacrifice macroeconomic stability. So I think the budget and the RBI's monetary policy as well, both of them should continue to take into account macroeconomic stability, because really this is about compounding, and we shouldn't lose track of that. Macroeconomic stability is absolutely key. And when the time comes where the global landscape is favorable, that is a time when we should push for the 9% level.
Right.
So for now, I think macroeconomic stability is absolutely critical.
All right. Well, that's on the macro picture. Let's see. It's a big week. You have the RBI policy on the 7th as well. Nishal Maheshwari joins in now to give us some cues on how he's looking at things. Nishal, good morning. Thanks for joining in. I want to first start with some of the auto stocks that reported their sales last week. And, you know, for companies like M&M, for example, it was a very strong set, both in the auto as well as in the tractor segment. Double-digit growth for tractors, autos, especially SUVs have done exceptionally well, over a 30% growth there. Do you think there's still momentum in some of these auto names?
Morning, Sonia. Yeah, I continue to believe there, especially M&M basically. I think it has been surprising with numbers, and this time I think the tractor was better than expected. And obviously the SUV continued to be pretty strong. So the order book, the waiting period, I think it's a pretty strong one basically as far as M&M is concerned. And the stock is not very costly also. So I think this is a good time to continue to hold on to the stock and maybe add at these prices also.
Okay, add at these prices also. Nishal, you know, so let's just talk about the other part of the market, right, which is new age stocks. And before I kind of come to you for the new age stocks, which were all the focus for the last 2 weeks or so, let me put out a couple of graphics for our viewers, which and I put this out as part of the piece on Editors Roundtable on Friday after market hours. But this is relevant and this will remain relevant. The common thread, and these are 5 stocks that I'm going to talk about. Let's have the first graphic up. What I simply did is compared where valuations for each of these companies is as compared to global peers. So, you know, that the first one is Paytm. It's up on your screen. This is EV by sales, 1 year forward. And you can see, I mean, for yourself. It's come down to 2.6 times 1 year forward EV by sales, and where the others are at. The next one is Nykaa on your screen. Still big difference between Nykaa and players like Ulta Beauty, Bath and Body Works. Zomato is the next one. Again, I mean, compared to DoorDash, Deliveroo, Meituan, I mean, you know, big difference still. And then I think we have Policy Bazaar, which I think is the next one which should come up on your screen. Delivery actually is the next one. Delivery has also come pretty close to where some of the global peers are. And the last one, of course, is Policy Bazaar, PB Fintech, where again, I mean, valuations have fallen pretty close to the largest player out there, which I could find, which is Goosehead Insurance. You know, Policy Bazaar at about 6.2, Goosehead Insurance at about 5.9. It's not to say that stocks have made a bottom, but at least a few of them, particularly Paytm, you know, there is Policy Bazaar and Zomato. I mean, in 3 of these cases, perhaps at the margin, you know, you could make the case that valuations now are not where they were when they were first listed. I mean, there was a big gap between where global peers were trading and where they were, but a year down, a year out, I mean, valuations have compressed. Now, it's possible that globally also valuations correct more, and that puts more pressure here. And it's also possible that more selling comes, right? And I think most likely it will, especially from Chinese large players and Japanese players like SoftBank, etc., which hold large stakes. But the point is, and I think it's perhaps time to ask the question whether at least a few of them, maybe 2 of the 5, are starting on their journey of a bottoming out kind of process. So I just thought should put this out. Nishal, any thoughts and anything you track in this space and broadly, your perspective?
So, though we do not track any of these stocks, basically, we're in the process to cover them. But I have definite views about all these stocks, basically. And I agree with you, basically, at the time of the IPOs, they were whatever way they were priced. But having corrected so much, Now, I think, Prashant, what we need to actually see is basically which has got a model basically which will lead to profitability, because once you become listed, the listed market sees profitability. And I see a couple of them basically, especially Zomato, Nykaa, Policy Bazaar. These three have very clear now path to profitability. But in the process, what you have to see is basically is the growth which they have been doing, whether that growth is going to get compromised. I see very clearly happening in Zomato, a 40% kind of a growth they were doing basically in quarter on quarter, which has fallen to something like 20%. And I think that is going to be the fallout basically, which we have to see. And then we have to compare, saying that at 20% kind of a growth, does these valuation still warrant a buy or not? So I think we have to give them a couple of quarters, but these are the three models which I am very closely following, basically Zomato, Policy Bazaar and Nykaa, because it has created a new service basically out there. It is the market leader. So these are two or three things basically which I look at it. So it's a new service, so it's a disruptor, it's a market leader in its space, and obviously the quality of management is very good. So I think these are the three stocks which I like in that space at the moment, which is on my radar.
Okay. Hi, Nishal. Morning. Nishal, China reopen has given some wings to the commodity space. As I'm looking at the Chinese rates, a lot of those metal related, whether it's iron ore or steel, they have moved up. Yes, they've corrected big time from the top. Would you look at playing these themes via stocks out here, maybe the ferrous or the non-ferrous space?
Morning, Nigel. I think we have to be cognizant of the fact basically that such a strong increase in the interest rates across the world and by Fed in particular, most likely is going to lead to some recession for a quarter or two, both in US and Europe. So I very clearly see that the export market basically is going to slump. So I think metal stocks at best is a trading play. I do not see basically it becoming a part of the portfolio at these prices.
Okay, all right. Well, let's do one thing. Let's take a bit of a breather from this stock talk and get talking to a corporate now. So Nishchal, request you to listen in as well and give us your comments. StoveKraft is the first corporate that we're speaking to today. The company posted a 12% revenue growth and a flat EBITDA margin at around 11.5% in Q2. To discuss the outlook and the way forward, Rajendra Gandhi, the MD of StoveKraft, joins us now. Mr. Gandhi, good morning. This has been a difficult year for your stock. The stock is down almost 40% this year. And even in terms of earnings, despite all the challenges, you've held on to your margins, but the revenue growth has not been that good. Are you seeing any kind of slowdown or tapering off of demand? And what would the full year guidance be for you?
Good morning. Yeah, on the stock price, it's impossible for me to comment, because I think that is what you play in the market. But I can tell you about the business. We are doing well. The business is as per the plan. We are growing. The last year was good. Particularly the first 2 quarters of the last year were, relatively good. And so when you compare the base, so we consider that the business is as normal and as per the anticipated growth plan that we have for the company. And in fact, there are favorable conditions. The volatility of the input cost has now stabilized on all fronts, whether it was freight or raw material. And on the demand side, I can say that last year, a lot of, because of all those lockdowns, the consumer was shopping, sitting at home. That is more of e-commerce, and this has moved to now a stabilized position where both e-commerce and the general trade are coexisting and doing normal business.
Okay.
Demand side, generally, ours is a seasonal. We have different quarters over the 4 quarters. The second and third quarter are relatively larger quarters, but particularly the second quarter has all the festivals built up in the quarter.
Okay.
And after Diwali, before the New Year, sales really kicks in. The November month is relatively softer over the other months.
Okay, all right. Mr. Gandhi, let's break it up into 3 portions. Exports is around 10% of your business. So are you seeing some bit of a slowdown out there? E-commerce is around 35%. Have you been giving high amount of discounts out there? Some of the competition has been doing that. So I asked you this. And on ground, demand from your trade channels is okay? All the three divisions, I want a qualitative input from you. Go ahead.
On the exports, we are growing the fastest this year. It is much higher than our company's growth rate.
Okay.
And we are seeing good, because we cater to a value segment even in our exports business. And because of the slowdown globally, we believe that these products that we cater to are gaining more momentum than normal. Or it is because of we are a value supplier, our customers are choosing us over others. And also the China plus one is also helping us. And more of our customers want to increase their portfolio in the buying range that they buy with us. So we are seeing very high growth in the export business. E-commerce has actually over the last year, I can say, softened a little, but the modern trade and the general trade for us has grown much higher than the e-commerce business.
Okay. Mr. Gandhi, just the domestic market, right? There have been lots of concerns that volume growth has been very subpar. Could you tell us in the third quarter, with 2 months behind, I mean, what's volume growth been like? I mean, if you can give us a ballpark.
It's not a very high growth in terms of absolute numbers because of the input costs over the year. But while it is softening now, over the last year it was higher than what we initially started with the third quarter. So it is not that a slowdown situation for us, but it is not that we have a very high growth rate in the unit numbers as well.
It was about 3-4%, right? H1 volume growth. And that is, and you've explained that before, the last time we spoke.
Yeah.
In Q3...
Yeah, the volume growth was smaller.
Yeah, in Q3...
We had a higher value growth, yeah.
Yeah, exactly. In Q3, is it similar? 2-3% kind of volume growth so far?
So far, yeah. It is in that range, a little better than the 2-3%.
Okay, 2-3% volume growth. On the margin front, you have guided for 11% EBITDA margins. But you did not raise the prices in the last quarter. So do you plan to do that? Because inflation has been hitting, a lot of your peers as well in the industry. Any price hikes that you'll have to take in order to maintain this margin level? And if yes, what would the trajectory be over the next few quarters?
On the contrary, actually, we are seeing a softening of the input costs over the relative quarters, that is the third and fourth quarter of last year. There is no need for a price hike to maintain our margin at what we aspire to. So we continue to have at the same level, or maybe in some categories we are able to offer better trade discounts to our partners. There is absolutely no need currently for a price hike.
All right, Mr. Gandhi, on your con call, you said that in the second half of the year, you'll see 10% volume growth. And for the year, you're guiding for the next 2 years, double-digit revenue growth. That's for FY23 and FY24. You're holding on to that guidance, right?
Yeah, on the revenue growth, we are seeing, we are experiencing a double-digit revenue growth. We continue to believe that we will end the year with a double-digit revenue growth. And
volume growth will be 10% for the second half of the year?
We are growing. It will be very difficult to comment immediately on the whole quarter. That is the 2 quarters.
Second half, yeah.
Including it's the whole second half. But currently we are seeing reasonable growth on volumes.
Okay.
It's not very high growth, but because of the higher value that we are realizing.
No, the reason, Mr. Gandhi, the reason I asked you is because earlier you were talking about you are doing better than 3%, but that's a far cry away from 10%. So you're saying you're growing, but maybe not at the pace of 10% in terms of volumes. Are we getting that correct as of now?
Yes, I think it is right to say that we are not crossing the 10%.
Got it.
But are we growing above the 3%? Yes, we are growing above the 3%.
Okay, and what about, given that input costs are cooling off, there should be an upside to that margin guidance, right, of around 11%. Do you want to guide for maybe 12 or 13%? Is that a possibility, or you want to stick to 11% and be safe and surprise us positively maybe?
No, so we always maintain now that we will want to protect the 11%. So giving a guidance beyond that is not correct.
Okay, we'll leave it at that. Thanks a lot, Mr. Gandhi, for joining in and giving us an update on the business. So that's the management of StoveKraft, they are a bit cautious actually on the volume front. They're saying November was a slow month for them. 2 to 3% volume growth is what they've done. Nishal Maheshwari is still with us. Nishal, it's reflected in the stock, right? I mean, in the last 1 year, the stock is almost halved. You're cautious here?
Sorry, Sonia, we do not cover it, so I have no view
Sure.
about this stock at all.
Okay. Just a quick comment on another stock that could be in focus this morning, M&M Financial, where the disbursals have been under pressure. I mean, on a month-on-month basis, disbursals are down 15%. Any thoughts on this one?
So I think a couple of quarters back when sort of a kitchen sinking happened basically for M&M Finance, I think from then onwards, I think the company has been maintaining well. I think the issue is not about dispersals, but the issue is about how well they are doing the collections. And I think that they have been continuing to do well in the last 2 quarters. And that's why we've seen the stock coming up from the bottom, basically. So we will watch basically for the current quarter how the dispersals been. But if they continue to surprise on the collection front, basically because they had an issue on the GNPA side, I think the stock will continue to do okay.
Nishal, just mentioning, I don't know if you tracked these, but these are a bunch of names which did very well in the broader market on Friday. Raymond was up some 16%. BHEL was up 7%. BHEL has done very well over the last couple of months. MTAR Tech, it's a company we'll be speaking with later, 8.5% higher. Radico was up about 7%. Anything you track out of these names? They could be sort of follow-through moves in some of these at least. Go on.
So I think Raymond and BHEL, these are the 2 stocks which we track basically. I think Raymond was because this is a wedding season. I think the management was there either on your channel or some other channel basically in this and guided saying that this is a bumper season for them basically for the current quarter and the next. If you remember, Raymond is now I think the only company basically which is selling woolen suitings. So I think, and they have now gone into the same category as Manyavar. So I think they are going to have a very, very strong couple of quarters. So I think the stock reacted to that. The other one,
BHEL.
BHEL, yes. So I think BHEL, I happened to speak to Coal India management recently, and they are very clearly guiding that the government is looking to add now thermal power once again. So I think that is what it is actually pushing the stock up. Though we have not seen much signs as of yet, basically as an order book, but I think market expectation is there basically that there are going to be fresh orders coming, especially for maybe new greenfield thermal power projects or for replacement of the old state level SEB thermal power plants. And that's why the order book may be good for BHEL.
Okay, well, Nishal, we need to take a short commercial break. So we'll do that for now. And when we come back,
having a good morning. Well, the SGX is suggesting that we're likely to pull back some of the losses that we saw on Friday. So that's pretty good news. So it's a good time to get in our technical experts. We have Sudarshan Sukhani as well as Mitesh Thakkar, who are back with us this morning. Morning, gentlemen. Well, Sudarshan, you go first. What would your trade be on the index?
Yeah, good morning. See, the trade for many weeks has been the same. Sorry, I have a bad throat. The trend is up. We must be looking to buy on dips or on breakouts. Today, I think the idea is to buy on a minor dip. An intraday dip or consolidation always comes. When you buy, place a 100-point stop loss and stay with the trend. But the bank nifty, which is consolidating, can simply be left alone because it's probably waiting for news. So focus on the nifty.
Okay, well, focus on your health as well. Sudarshan, I hope you get well soon and take it easy a bit with that throat, right? Mitesh Thakkar is also with us. Mitesh, good morning. This momentum has been very strong. You think there's a pause coming, or do you concur with Sudarshan's view that every dip should be bought?
Good morning. My sense is that there could be a pause. I think for the simple reason that the last rally which started on the Nifty was from levels of 18,150. We made a high of around 18,887 or something. And now I think, the hourly and the 2-hourly indicators which are overbought are now, showing that signs of mild tiredness or loss of momentum. So I think we might not cross the recent high or the highs of Thursday, which was done last week, immediately. And we could do a range of about broadly 18,650 to about 18,880 for the next few days. In the worst case scenario, I think there could be a decline or a profit booking kind of a move down to about 18,450. Unless until that is being violated, I think then I'm a buyer on dips, but not on positive days. But I think closer to support areas, I think it's clearly a trade which will favor the long positions.
Okay, all right. And what about, let's get into stock-specific action then. Mitesh, you go first.
Good morning, Nigel. I have 3 buys to a sell. Apollo Hospitals is a buy with a stop at 48.20 for a target of 49.90. Grasim, disclaimer, we have some positions here. That's a buy with a stop below 1800 for targets of 1865. And SBI Life is a buy with a stop at 1280 for targets of 1335. On the sell side is Eicher Motors. Keep a stop at 3365 for targets of 3270.
And Sudarshan, how about you? What would be on your buy and sell list this morning?
Well, Cummins is a buy, stop under 1420. Sorry.
Sure.
Comments.
I'm very sorry. Tech Mahindra is another buying opportunity. It just broke out. Stop under 1090. GSPL is my only intraday short. The stop is above 269. And finally, the last buying opportunity is in BEL. That's a buy on dips opportunity. It hasn't actually given a buy signal, but it's been in a trading range and worth buying into as a dip. Stop below 103.
All right, gentlemen, thanks for that. We'll slip into a quick break. On the other side, we'll come back with the pre-opening rates.